The Doc is pleased to announce the launch of thenewsdoctors.com, a new website dedicated to providing 24/7 access to breaking news worldwide, from sources including Zero Hedge, RT News, Silver Doctors, and exclusive articles from the Doc and Eric Dubin. Thenewsdoctors.com, changing the way you view news.
This is the Doc with the SD Weekly Metals and Markets. Joining me tonight is special guest hosts, filling in for Eric Dubin, our Goddess Bill Murphy, and one of the premier gold experts out of London, Alasdair Macleod. Bill and Alasdair, it's really an honor to have you both on the show.
My pleasure.
My pleasure, too.
Well, the big story in the markets this week was Wednesday's FOMC statement, as the Fed failed to announce a taper to QE, and once more uttered gibberish that they are prepared to increase or decrease QE as the conditions merit, which is Fed speak for the economy would roll over if we even began thinking about tapering QE, or actually announced it anyways. So the fact is, in my opinion, that the bond market has already begun to roll over, even under the guy's threat of QE, of the Fed tapering QE at some point over the next year. The 10-year rate has spiked up from around 1.6% in May to nearly 2.75% here in early August, and it's been almost a 115 basis point move on the 10-year in under 3 months, almost a doubling of the rate. It eased off a little bit here on Friday. On Thursday, it was up over 5%. So, Bill, I'd like to start with you here. Has Bernanke's Fed completely backed itself into a corner with regards to QE and monetary policy?
Oh, I don't know. It's funny what you're talking about, just gibberish. I'd like to bring to the table what we keep pointing out to people for at least a decade now, that the gold cartel, as we call them, tends to attack on Fed speak, as you mentioned, and around the U.S. jobs report that we had today. This time they did it both times exactly the same manner ahead of time. Gold ended the week in the FX market last week at 1335. Now it's about 1310, 1312. They bombed the market twice ahead of time to defer from all the stuff that you're talking about. So, as you said, it's gibberish. I mean, yes, no, but in the end, so what? I mean, in the sense that back when they started taking the gold price down from 1793 in the first week in October, it was right after all this QE stuff in the United States and then Japan, and the Dow's at all-time highs today, and yet gold has been crushed. It's almost irrelevant from my standpoint. I know that sounds a little odd, but so what? They've had all this QE and gold's been killed, so what's the difference? Where gold's going to go from here we can get into later, but I think that, again, as you said, they talk this way, they go that way, taper, non-taper, the jobs report's good, they hype the numbers with part-time work. It's all nonsense.
Alasdair, your thoughts?
Well, about taper, I think people miss the point about taper. Taper actually finances the banks. It stops them from going bankrupt. It also finances the government's budget deficit. Now, that's come down a little bit, which is encouraging, if you like, for those who think that there may be a way out of taper. But the fact of the matter is that if bond yields rise, then that means that the asset values on the bank's balance sheet start declining, and they are very highly geared. And it doesn't take very much of a fall in bond prices, basically, to wipe out shareholders' equity in the banks. And not only that, but the Keynesian approach to economics is that you need to stimulate the economy in order for the economy to grow. So all the Keynesians and the monetarists really do believe that if they withhold this stimulus, then the economy is going to tank. So this is why they are so reluctant to do it. It's on those three counts. I think the banks go bust, the economy takes a nosedive if you withdraw it, and also the government has got to pay its bills. And that in essence, I think we have to bear in mind through all this conversation, and that's why they can't withdraw it.
And when we're speaking of banks going bust, we're talking about derivatives and interest rate swaps.
Which is exactly why they killed the gold price since early October. They're petrified of just that. You're correct. And Had they left gold alone, right now it would be screaming. and it could have had even a more deleterious effect on bond prices and derivatives, which you could have a black swan event at any time. It's because they're so massive now in the quadrillion range in terms of notional value. Nobody knows what the end result's going to be.
The last number I've seen for JP Morgan, their interest rate swaps were in the neighborhood or range of 60 trillion. So Alasdair, give our listeners some perspective. When you have interest rate swap derivative bets on the U.S. Treasury, the 10-year, describe to our listeners what a 1 to 2% notional move would mean.
Well, on a 10-year bond, a 1% increase in yield, I think it basically pushes the price down by something like 5 to 7%. It's a figure like that. It's a long time since I've been dealing in bonds. I mean, when I used to be a broker, I used to know these things. But that's the sort of effect we're talking about. Now, the banks can absorb this if interest rates rise slowly because they can adjust. But I think you're right to mention the interest rate swaps, because I don't know how the mortgage market works in detail in America, but I can tell you that outside America, the banks are offering fixed rate mortgages so that you can take your floating rate mortgage and you can convert it into a fixed rate mortgage to lock in these low interest rates. Now, the other side of that deal basically is that the banks are taking out interest rate swaps. They're exposed to a rise in rates. The total interest rate swap market on the last Bank of International Settlement figures we had was $440 trillion. So JP Morgan's 60 trillion fits in that. I think Deutsche Bank has got a figure like, 30 odd trillion as well. Other banks around Europe are similar. This is probably, other than straightforward sort of currency positions, these are the largest exposure that the investment banks have in the derivatives markets, and they cannot afford a sudden jump in interest rates. A gradual one they could probably handle, but it would have to be so gradual. You're talking about a market which can really be contained. Now, history doesn't tell us that it's really that easy.
All right, thanks. Well, I'd like to move right along here and get into an interesting topic that Alasdair has discovered, and the guys at GETA followed up on this week. Alasdair has noted a discrepancy between the Bank of England's 2013 annual report on February 28th, which listed the figure for custodial gold at the Bank of England at 505,117 individual 400-ounce gold bars. And the discrepancy between that and information given on a new virtual tour of the Bank of England's vaults on their website, which was posted in June, which stated that the Bank of England held at least 400,000 400-ounce gold bars. So Alasdair astutely picked up on the discrepancy of just over 105,000 of the bars, roughly 42 million ounces of gold. The implications are that the BOE has potentially leased out into the market over 1,300 tons of gold over the first half of 2013. So I'd like to get Alasdair to expound on his thoughts on this matter here. Alasdair, so how much of this 1,300 tons of gold do you believe were actually physically shipped east? And how much of the gold sitting at the Bank of England last Christmas has now been restamped and is sitting somewhere, say, under William K's vault?
Yeah, well, it is, I think, the very important question that we all want to know the answer to. If you look at the supply and demand figures for gold over the last year, and not just recently, but over the last year, there has been very little net gold available to other countries other than China and India. On my calculations, over the whole of the year, there's been about 138 tons of free gold, after you take into account the fact that the Chinese, the Russians, and also the Central European states do not export their gold. They hang on to it. So that reduces mine output from an estimated 2,600, 2,700 tons to around about 2,000 tons. The amount of scrap supply in the West is tending to fall. I'm told that by the refiners that we deal with, and that I would currently estimate is around about 500 tons a year. The ETF selling has only been a feature this year. All last year, despite the fact that the price of gold wasn't really going anywhere, ETF purchases. I mean, it was net, the ETFs were growing. So it's a combination of factors means that there was very little gold available for the rest of the world. And on the known figures that we have, I estimate that the sum total of free gold, as it were, for everybody else, Vietnam, Turkey, and all these other gold-hungry countries, was only 138 tons. Now, that figure is obviously not terribly accurate, but it gives you an idea of the sort of size of the market. Now, there is little doubt that there was gold being supplied into the market by Western central banks to try and make up this deficiency. Otherwise, the price wouldn't have declined. It's really as simple as that. Then something happened in March, which was a very, very important event, actually just before March, and that was the Cyprus blow-up. What that did was it warned everybody in the Eurozone that where they have bank accounts, they have got to think very carefully about the quality of the bank, because a bail-in, if you had more than the insured amount, which is the equivalent of $130,000, then that was going to be cannibalized into a bail-in if the bank where you have your bank account actually failed. Now, the reason that this is important is it not only did it trigger the thought processes amongst people with ordinary cash deposit accounts, it also triggered the thought process amongst holders of unallocated gold accounts. And it was for this reason that ABN AMRO and then subsequently Rabobank were forced to write to their customers and say that they were unable to settle their gold accounts in physical and would settle them in cash instead. Now, this was a sign of a strain in the market as a result of the Cyprus thing. It was, if you like, the last straw which was going to break the market's back. So what had to then happen, quite simply, was that the central banks had to take the steam out of the market. Otherwise, there was going to be a real crisis. And as we saw, this started with two large sell orders early in April, which crashed the COMEX market, took out all those stops, and turned everybody bearish. I mean, by everybody, I mean people who normally think like investors as opposed to people actually hedging systemic risk. The other side of that story was that it stimulated massive demand, an acceleration of demand in Asia, and not only in Asia but also in America itself, because you started having record sales of silver eagles and gold eagles and all the rest of it. So, everybody who was sort of thinking in terms of there's a lot of risk in this system, I don't like what's happening, I want some protection, took this as an opportunity to add to that protection. So there was an acceleration, if you like, in demand for physical. Now, the reason we know that that has continued is because under normal circumstances, the price would have bounced after the takedown, and the shorts would have been squeezed, and we would have the price already, I would suggest, well over $1,500 and perhaps well over $1,800. But no, the central banks must have continued to supply the market because there is nowhere else that the gold can have come from to satisfy that ongoing and extra stimulated demand. So we look at what's happened with the Bank of England custody gold very much in that light. Now, I would say that a figure like 1,000 to 1,500 tons of gold was what was required to keep the gold price down following the Cyprus banking crisis. And hey presto, we find a more or less matching figure suggested from the figures coming out of the Bank of England, one of which is official in the sense that it's in its accounts, another of which is sort of perhaps an indication rather than a real figure, given that it's appended to an app. But for the critics who will say that the figure on the app isn't really a real figure because they just say over 400,000 tons, I would venture to suggest they don't really understand the precision with which the Bank of England operates. They do not put out false numbers. They'd rather put out no numbers, but they will not put out false numbers. If they said over 400,000, they're not saying over 500,000. And I think that is the point. Not only that, but with all the inquiries that following my article on this and the exposure of this on the Max Kaiser show, lots and lots of people have contacted the Bank of England by email, by telephone, and they've all got the same story. They're saying that 400,000 ounces is over 400,000 ounces is an open figure. And it doesn't indicate anything at all. Well, that's absolute rubbish. If they really did believe that, then they could quite easily come out with a statement and say there has been no material change in the level of custody gold in our vaults since our year end, full stop. But they can't say that. So this I think is very important. It's confirmation of the work that GATA has been doing all these years. It's really their very hard work exposing the interventions in the market, and always there's been just sort of little bits of evidence, circumstantial evidence, nothing you can really grab hold of other than an official in an unguarded moment says something or something appears as a minute somewhere. Here we have got yet more confirmation. There is now absolutely no doubt at all that the gold price is completely manipulated. And in the current economic circumstances, my goodness, we can understand why. Because if they didn't manipulate it, then as Bill points out, there would be a real crisis.
So I'd like to get your thoughts here, Bill, as well.
Well, I think, first of all, I want to salute Alasdair for brilliant work. And, of course, he's got GATA jumping up and down, and it all makes, again, he can't say any better what's happened and why and where the gold is coming from. I'd like to ask Alasdair, because they're still at it. I mean, the way they traded this week, as I mentioned, we follow in detail what we do, and it's all the tricks and maneuvers and times a day and what they do. It's aggressive as ever. But supposedly the bullion banks are reducing their positions. That's what the documents say. How much of this gold that I am sure you've uncovered that's been used is left, knowing that this GOFO rate is unprecedented negative for maybe 20 days now? How much do you think that gold is still left that they have to play with, or they even go after more? That's what we're trying to figure out.
Well, I think we've got to look at it in a slightly different context. Of this gold, the Bank of England doesn't actually own any of it. It doesn't even own the British government's gold, which, by the way, is that's 310 tons. Yeah. Now, what we have in Europe is a crisis, and you've got Italian and French governments in particular, and also the Spanish government, I think, very, very hungry for sources of finance to keep the show on the road and not have to sack lots and lots of civil servants. So it seems to me that gold leasing is the easy option out of dealing with their problems. And I think that's basically what they have done. So my view is that the supply of this gold isn't directly the Bank of England, because the Bank of England is just the custodian. It's with the blessing of the Bank of England, because the Bank of England doesn't want to see the market explode. But I think that the source of it really is probably Italian and French and Spanish.
I agree with you totally. Absolutely. So understand that. I'm curious of how much of this that you think have hit the market, I know it would be just a speculation, is still available before whatever was taken out runs out.
Well, it could well be. We don't know the answer to that one, Bill, and I don't have too much of a feel for it because I don't know what the starting point is. I mean, we all know that the central banks, have now amended their accounts to say gold and gold receivables. I mean, that means that they haven't necessarily got the physical there, but they're accounting it for a gold. This stuff has probably been leaching into the market for some considerable time. And so the gold position is not as is stated in most of the major central banks around Europe. I think I would exclude the Bundesbank from this one because I'm impressed with the openness with which the Bundesbank has treated its gold. It does actually tell us. They've actually told us where all their gold is. You can see their schedules of all the gold movements in, sort of London, New York, and so on and so forth. But no other central bank has been that open. And I think that there is a very good reason for that. And that is that the central banks, and here again, I always come back to France and Italy in particular. Spain in the past has certainly been the case, but they've declared their sales in the main, and they're now down to a relatively small figure. I think it's about 600 tons or something. But the biggies definitely are Italy and France. Now, how much of that they've got, I don't know, because I don't know when they started. Assuming they started disposing of their gold through leases and all the rest of it. But at the rate at which the demand for physical is expanding worldwide, I don't think it can be very long before they're taking out. And the evidence of this, perhaps, is the negative go-for rates, which have been negative now for, about 20 days in a row. I mean, this is completely unprecedented.
Yep.
So I think that's probably telling us that this is coming to some sort of crunch point. Now, there is another point which I think we must bear in mind, and that is that while the big bullion banks have sorted out their short positions on COMEX, the bullion banking community have not sorted out their fractional reserve position on the LBMA. They are still technically short of large amounts of gold. And for this reason, if the gold price rose sharply, that could stimulate a crisis in the physical market in London. So, we're at actually a very important crossroads here. And I don't know when it's going to happen, but what I do know is that the price of gold has got so far out of whack with where it should be on any sensible basis that when it corrects, it's going to correct, I think, very, very violently. And I've done some work in terms of comparing the quantities of gold with the quantities of dollars in circulation using true money supply, the Austrian measure, adding in excess reserves, which I believe should be included in that. And if you adjust the price of gold for the increasing amount of gold over the years and the increased amount of dollars over the years, gold since 2000 has gone up less than 40%. Now, that's quite a statement. You've got to look at it in that light. So the idea that gold is, it's gone from, over that time, from 283 to, currently 1,300, I mean, that's absolute rubbish. You've got to adjust it for the quantity of dollars that's expanded, and also, to be fair, by the quantity of gold that's expanded. And the result is gold has only gone up 40%, and we have an international banking system which is completely bust. So, my case rests, really. It's as simple as that. We are so out of whack. I mean, it's just absolutely unbelievable.
I'd like to talk a little bit. Bill was asking about where the gold went and how much might still be offered in the market. And I wanted to point out a few statistics here that might give us a little insight into that. Gold touched 1179, I believe, as a bottom in early July. The July, I don't think even the June numbers for Chinese demand are not out yet. We do know, however, that Chinese gold imports from Hong Kong skyrocketed 40% in May to 127 tons for the month when gold broke down below 1,600. China has already imported, I think the total already is over 20 million ounces of gold for the first half of 2013. And this compares to the 2012 annual total. The whole year of 2012 was 26.7 million ounces. So they're already, and this is before June or July numbers, they're already just about equal with 2012. In 2011, the whole year was 13.8 million ounces. So China imported roughly 50% of global mine production during the first half. And this was at a gold price in the 1500s and 1600s. I'll ask you first, Bill. What are the June and July numbers going to look like for China's imports? And again, this is just from Hong Kong. This is only from Hong Kong into mainland China. I mean, are we going to be looking at 500 tons?
It's so hard to do. The only thing we could take credit for is way back when, I would talk about 7, 8, 9 years ago, we realized through this secret agreement through one of our fellows was privy to that Chinese was quietly importing gold for years and years. We kept talking about it. They were going through intermediaries, and then they announced it, whatever they went up from 450 tons to 1,000 and something tons. And they're very secretive. I guess that's my point. And maybe Alasdair's got a better handle on numbers than I do. You never really know what they're doing, and they're not going to tell you. and some of the things have become more opaque in the previous. Clearer in the last number of years. But I wouldn't have any idea except to know that they are certainly, as you pointed out, going all out, accumulating whatever they can, because they know what Alasdair knows. They even know what Gata knows. I've had 3 conference calls with a Chinese investment corporation years ago, and they know what we know. And we've had the WikiLeaks State Department cables and talked about this, the manipulation of the gold price that have been intercepted, and that's important because they know how suppressed it is artificially. So, as Alasdair said, it's totally out of whack, and the Chinese know it. So they're buying whatever they can, whatever the official or unofficial numbers are.
I think that's right, Bill. My analysis of it is as follows. The Chinese government are not going to go into the markets and rock the boat. What they do is they take all their internal production and they hang on to it. Now, that's roughly 400 tons a year. I think any other production within Asia, which would otherwise come on the market, I think the Chinese, on a government-to-government basis, are quite happy to soak up any supply. What we do have on the private sector is we have got the volumes of deliveries through the Shanghai Gold Exchange. And I can tell you that at the moment they're running at approximately 200 tons per month. So if you bear in mind that free world gold in terms of mine supply is approximately 2,000 tons, and you also bear in mind the relatively low level of scrap supply, which is now running, I believe, at about 500 tons per annum, the Chinese alone are taking almost all the free supply. And then we've got India. Indian demand has just been shooting off the charts, and the reason for that is because the rupee has been going down and down. I mean, my favourite statistic, if I can bore you with this just for a moment, which just proves how central gold is to family life in India. It is the family pension. Back in 1965, a grandfather of today who would have got married then would have had his dowry in gold. When children come along, he buys them gold. Festivals, he buys gold. Children get married by gold. Grandchildren buy gold, etc., etc. When he started on that in 1965, gold was at 170 rupees an ounce, fabricated into jewelry. Today, it is over 80,000 rupees an ounce. Now, you're not going to frighten the Indian off the idea that he should put his savings into gold because it's safe. No government is going to stop him doing that by producing a diktat saying we're going to restrict imports, we're going to put a tax on, because all that happens is that the smuggling increases. And indeed, so much so, it's forced Pakistan to try and put an embargo on imports of gold because they know it's all being smuggled across into India. So, we're now talking about the Asian continent, which is 2.5 billion people. If you talk about just India and China alone, people who are big savers. The Chinese save something like 35 to 40% of their salary. The Indians, we don't have figures on, but it's going to be like that because you don't have the support system of a welfare state. And they are becoming wealthy. They have become very wealthy over the last 10 years. They're going to overtake many other countries in terms of GDP per head and all the rest of it. And the result is that the imports of gold are going to increase and increase and increase. And the central banks in the West have been caught on the hop on this, and there's no other way of putting it.
Right, and as Alasdair just alluded to, that's really the latest news, that Pakistan has banned the gold imports for 30 days. As you mentioned, Alasdair, as a side effect or result of India's ban and all the smuggling now. So we have Pakistan banning gold imports for 30 days. We have India really in vain attempting to put the cap on gold importation. And as we touched on earlier, the Chinese demand remains off the charts, and we haven't even seen the numbers that are going to be huge, in my opinion, from when gold hit its bottom around 1180. Those demand numbers are going to be massive. We've discussed the GOFO rates, now seem to be in a permanent backwardation. Today marks 20 days, 4 full weeks of backwardation, and the market in London continues to state that gold in hand is worth more than cash in hand. And then we also are seeing massive inventory drawdowns at the COMEX and the ETFs like the GLD as well. I think Alasdair is likely spot on with his call that about 1,500 tons was needed in the aftermath of the Cyprus bail-in to prevent a confidence event, really invoking a banking crisis or collapse in the gold market particularly. So I want to thank you particularly, Alasdair, for your research and work into that. It's been excellent and quite eye-opening. And I know Geta appreciates having someone join the fight as well. So I think that'll be a good place to wrap it up for here. So for Bill Murphy of Geta and Alasdair Macleod, this is the Doc with the SD Weekly Metals and Markets. Thank you both so much for joining us here. It's really been an honor.
Anytime, it's been great fun.
Yeah, anytime. I've thoroughly enjoyed it. Thanks very much indeed.
SD Bullion.